freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how you doing today?
I'm doing great. I'm excited to do another podcast recording. It feels like these are becoming a regular thing now.
Yeah, I know. It seems like we're doing them on the weekly, which I guess was our...
We are.
I guess that was our objective from the beginning with this, so it's good that we're sticking to it. No, it actually is exciting. Like, we're starting to see the podcast count go up, and that's, I don't know, for the 6 people that listen, I guess that's a good thing. We're excited to have our strong listener base. What's that?
We're up to 6?
I think so.
Ooh, exciting.
I keep getting the download reports.
Nice.
So, no, it's good. But for all 6 of our listeners, we're very, very appreciative of them, and hopefully we can provide some value to more people in the future. The beauty of this thing, this is one of the reasons I like podcasting, right? These things are forever. Like, we put this out here, and like, people that discover us 5 years in the future can go back and listen to some of these things, and hopefully we're better in the future than we are now. But
doubtful.
Yeah, well, yeah, you just never know. I choose to remain optimistic about that we're gonna continue to improve. But I still think we're talking about valuable stuff, right? Like, I think the topic we got today is kind of an evergreen one. It's something that we do that not a whole lot of other folks, especially in real estate circles, don't necessarily do these types of deals.
Other than everyone that did multifamily value add and now has transitioned to oil and gas.
I mean, yeah, but like, I guess there's some people that have done that, but like, you've been into this for a while, right? You're definitely not new to this space, and I don't think you can kind of accuse certain syndicators of transitioning to whatever the next hot thing is, and I don't think that's the case, right? And I mean,
not here, no. Yeah,
for sure. And so, I mean, just to dive right into it, we want to talk about oil and gas, and it's something that it's a broad space. People throw that out, and it can mean different things, and there's a bunch of different ways to invest, and there's a lot of ways to lose money in this space. And I think you got to be, if you're looking at it from a passive investor standpoint, you got to know what you're getting into, right? Every oil and gas investment, if you hear someone saying, well, this is oil and gas, they're not all made equal. And even the sponsors are not made equal. The operators are not. The deal types, there's a lot about this space, but it can be a very, lucrative.
It's similar to saying I'm going to get into real estate, right?
Exactly.
It's not just, I'm in real estate. It's single family homes, and okay, what market, what type of real estate, so on and so forth.
That's exactly right. But it's one of those things that I feel like it's relatively easy once you sort of hone in on especially the types of deals that we like to do, which I think are very, very good from the passive investor standpoint. I think it becomes that is easy to grasp, and it's easy then to put up some really quick filters that when you start seeing others pitching different types of deals in the same space, you can be like, oh no, wait, that's not what I do. That's not what I'm interested in.
Yeah, or even to diversify inside the space, just as some people will have, they might personally operate a bunch of single family homes, but they don't ever want to buy an apartment building and operate it themselves. So they'll go with someone else, right? And just as plenty of passive investors might hold oil and gas stocks, maybe they're already very bullish on the energy sector. They don't specifically own any wells. And that's really what we focus on, is investing in specific oil and gas wells. And normally, it's like buying title to a specific property. You're not buying a company. We're buying a percent ownership in, an exact API number, right? So it's they're parceled out, and you buy, 5 wells, 2 wells.
Well, before I definitely want us to get into that, because I think that's an important part of the way that we look at this space and the way we put deals together. But I'm curious, you've been doing this for several years. What got you into this space? What do you like about it? What have you learned? Just kind of some background from how you were introduced into this and started putting deals together.
Yeah, so started from someone telling me about an oil and gas deal, and actually a mentoring club that me and you were a part of. There was a provider in there that was offering an oil and gas. They were an operating company, right? So they owned a lease, they had drilling rights, And there's a handful of different ways that we can dive into about how you can own oil and gas, but essentially there's the landowner, the operator, and then the investor, right? And a lot of times the operator has capital in the deal too, but so the people I was working with were the operator. Their deal seemed good. First time I'd been exposed to the space. Kind of my first passive investment, honestly, outside of stocks. It was my first syndication I had ever personally invested in. And the numbers were just flashy, right? They looked great. The tax return was good. That was one big reason, right? It's like 80. Everyone markets 80% in year one, and it depends kind of on how bonus depreciation is categorized in that given year. But a lot of times it's higher. It's normally 90%, and then there's some tax benefits on the back end. But so, the tax benefits were good. I was making a lot of money and looking for another tax advantage investment, and then the returns just looked killer. Now I'll tell you, we didn't get those returns, and that's probably the first thing to talk about in oil and gas is that a lot of times if the returns seem too good to be true, they are. So it's important to understand how the capital is returned. It's totally different than real estate, where the cash flow is almost the opposite. Oil and gas, you want to get all your money back in the first few years, and then trickle pennies in for the rest of it, and then on real estate, you trickle pennies, and eventually you double your money, right?
That's a good point. And that's something I tell people, first of all, because that, it's always the question. I would argue it's the most important investor question is, how do I get my money back? And there's not, in the types of deals we do, there's not a sale event, right? Like there's not, the objective is not to sell you acquire an asset, do something to it, or take some cash flow and then sell the asset down the road, as it is with real estate. This is a purely cash flowing asset. And the idea is that if you invest $100,000, the first $100,000 of distributions that you receive, you should treat as a return of your capital. And then everything from that is the actual return on the capital.
Yeah. I would argue, just depending on how you want to play it, if you were going to do and this is all philosophy at this point, but if you have a $100,000 investment, let's just say you're a super high W-2 income earner, and I love to use the California example, right? Because you're making $600,000 over here, you might be being taxed in 50% in California. So if you're getting taxed at 50%, and you put $100,000 into a deal, and you get a 40% deduction, or an 80% deduction in year one, that's $80,000. $80,000 deduction at 50% is $40,000 saved. So you really only have $60,000 in the deal. And one way or another, that $40,000 was going away, right? You were either going to find one other tax advantage investment, or you were going to give it to the Fed and the state. So then you've only got $60,000 to return, and depending on how you want to look at it, right, it can make the economics look better. But it comes back to, like you said, treating that initial return as not, oh wow, this thing's performing great, but okay, we're getting our capital back. It's time to reinvest this.
We can certainly dive deeper into the tax benefits, because I think from a passive investor standpoint, that's one of the most appealing aspects of this space. But I do want to go back on something you mentioned earlier, just to kind of like set the groundwork, because this was something when I first got into the space, I had to get educated on. It's kind of not the capital stack, but the ownership stack. And you quickly referenced it, right? You've got the person that owns the land, so the actual landowner, right? The person that has title to the physical piece of land.
Well, and the mineral rights more specifically.
And that can be that can be abstracted away, right? Yeah. Someone could own the land but have sold off the mineral rights. And so you could now own the mineral rights but not own the land, correct?
I believe so, right? It's probably going to change territory to territory, and then in that case, you would be working with the mineral rights owner to have rights to drill, and the landowner for land access.
Yeah, and so it quickly, like there's a lot of layers that can show up here that you don't really have this in real estate, right? Like the most,
especially when you're talking about random land in the middle of nowhere that's been passed down for generation after generation after generation, and now they found oil on it. There could be 100 errors you're trying to go find to get all the title paperwork dealt with, so that you can actually start doing distributions.
Yeah, and that's and that kind of speaks to the fact that you can divide this off in, I don't want to say infinite number of ways, but you can slice these different layers of ownership up into a lot of different percentages and people and crazy like fractions of a percent and different things like that.
And those fractions of a percent could be returning hundreds of thousands of dollars a year.
Right. So to again hit on the different people, I think usually from a passive investor standpoint, you don't really care about the landowner. You probably don't care about who even owns the mineral rights, but the operator is very, very important. Arguably the most important entity or person in this whole sort of ownership stack, right? And we talk about the operator, we're talking about the person or the team, the company that is actually out on the physical piece of land operating the equipment to drill the well and pull the oil and natural gas out of there. So I don't know, do you have anything, is that an accurate way to kind of frame it?
Yeah, I really think, kind of going back to just sum up what you said, is having an operator who is high quality matters more. It's, same thing in real estate, right? You could have an awesome piece of real estate, but if your property manager sucks, you're not going to get any rents, right? Because maybe they're not collecting rents. The same thing. If you're not producing oil out of the ground, if you're not fixing issues as they come up, if you're not drilling correctly and hitting the targets that you want, right? I mean, it's not trivial to even drill a vertical well, but when you get into the horizontal stuff and the fracked wells, I mean, you are drilling down 6,000 to 12,000 feet and going horizontal for a mile in between a specific layer of earth and then fracturing the whole thing, right? I mean, you had to be right on your targets.
So I think that kind of goes into maybe, I don't want to say, again, the most important topic, but very, very important, which is due diligence on the operator. And I think usually if you're a passive investor, you're generally relying more on the sponsor, the person, the team, such as like Adam and myself, that are bringing you the deal to be doing this. But still, it's important to kind of know what goes into it. So would you Adam, talk about like a little bit when we got a new deal that's coming up and it's with XYZ operator, like what are some of the things, the questions you ask, what you look for, what you like to see, things like that, and maybe not even just on the operator, but on the type of deal itself, because the structure and what is specifically being offered is an important component to it also.
Yeah, and I think, in the beginning here, it's one of those things that we've talked about, right? And there's speed around it sometimes faster than a real estate deal, because the working interest that we'll go out and buy, especially if it's a really hot deal, it's getting brokered to a lot of people, just like a hot apartment building, right? If you got an apartment building that is the next great thing to hit the market, you might be getting multiple offers on it, especially if it's priced right. And a lot of time, the oil working interest that we're able to go out and buy is priced right? We're buying the ones that seem to make the most sense. So is everyone else. So we don't have a whole lot of time to act. And essentially what the high level bullet points that we look for and the people we work with look for are the operator's track record, right? How many wells have they drilled? Have they drilled one well in their entire lifespan? Okay, well, we're probably not going to invest with them, right? Have they drilled 100? That's decent. 1,000's better. It just depends, right? Have they drilled 1,000 in Louisiana and none in Colorado, and this deal's in Colorado and a totally different type of play? Well, that's a little different, right? So just kind of understanding their track record and their ability to execute. And then the second thing we look for is offset production. So we're looking for, it's just like comps on a street when you're looking for house sales. If we're looking for a well at, X and Y coordinates, what are the wells that have been drilled around it produced? Have there been no wells drilled around it? Is this a total wildcat? And that's not something we're looking for. Is it, the well next to it produced great and was drilled by the same company, like the deal we did back in August? Sure, that looks great. And, we're happy doing those types of deals.
So I think you kind of hit on a couple things. You mentioned the term wildcatting. And I think that's, again, when you get into this space and there's different ways to do it. Just like, as you said earlier, there's different ways to do real estate. And I think I'm going to try to come up with an analogy on the fly here, but the types of deals that we like to do are not the ones that would be equivalent to, let's say, real estate development, right? Where you're starting with just a empty piece of land somewhere and hoping to, the idea is there's demand for some sort of asset type and we're going to build it there and then eventually sell it, right? And it's somewhat speculative. I mean, there's speculation. All investing involves risk, of course, right? I mean, you're obviously hoping for future returns. Like, none of that's guaranteed, but at the same time, a development deal is almost always going to be more risky than some value add apartment building where it's like, well, no, we know there's already people that want to live in this building, in this place. We're just going to do things to make it better and increase the value. I think that's somewhat analogous to the types of oil and gas deals we like to do, right? Where we're not going out looking for like the place where it's, we're going to go drill somewhere that's never been drilled before. We don't know whether there's going to be oil there or not. Like, yeah, that can have some amazing returns when you strike oil, but it's also the absolute most risky way to do this. And I think that's probably also what a lot of people, when they hear about oil and gas exploration or drilling, that's what they envision, right? It's like, oh, we're going to invest in this thing and we hope it's Jed Clampett finding oil and all of a sudden everybody's wealthy. And that's not what we do.
And we normally look for proven undeveloped, right? So, it's a term, and it just means that there is proven oil in this area, right? Someone went in and wildcatted, drilled the field, proved that there was oil. There's been other offset wells that have done well, and we are coming in to drill one next to those wells, right? And hitting similar but different targets, right? It's not like it's all one big pool. We hit, and I'm not a geologist, but we hit, similar targets nearby. And then then the layer up from that is, Dustin, as you were talking about, the analogy would be like buying a building that's already been rehabbed and is cash flowing. You're going to get less of a return, but it's going to be more stable. And it's the same thing with oil and gas. You could buy a well that's already been drilled and is producing, but you kind of know what the return is going to be. So you remove the risk, right? There's always a risk that when you drill a well, you miss and get nothing, right? There could be total failure during the drilling process. We've had projects like that. It's not what we look for, and we try to create ways to mitigate that by like having multiple wells in a project or working with larger operators, right? I mean, we did one deal one time with an operator that seemed great. They were going to do 2 wells. They had drilled like 5. The guy had 40 years of experience and seemed to know everything and everyone, and we missed both targets. Mechanical failure and 0 return of capital.
And I think that speaks to the risks in this space, and it's somewhat, there's higher returns and there's some occasionally eye-popping numbers, but it's also I would not compare this with some sort of stabilized real estate, even light value add sort of thing, right? The returns are not made the same in this. There is risk here, and this just gets to a general point of anytime you're investing in anything, you should never invest more, even if it's the most, sure thing you can think of outside of maybe treasuries. You should never invest more than you're willing to lose, or more than you can stand to lose, right? Because you can do everything right, and occasionally things just go wrong, things that are completely out of your control. You touched on doing some things to mitigate risk, and that's when I've explained some of these projects to investors. That's what I like to say. It's like, well, this is a riskier space, but we like to do deals where they have been inherently de-risked. So experienced operator, proven field, multiple wells. So it's one of those things
Drilling
to where
timelines and permits, right? You can go and invest in projects that haven't even been permitted yet, but most of the ones we do, most, if not all the wells in the project have already been permitted. Yep. And sometimes there's a drilling rig scheduled to go start drilling, or they've started drilling.
Yep. So, and that's the beauty that I like this space that we kind of play in, because I feel like it's in that good spot of where there's enough speculation to still have some really good returns. But the major things that you look at when a deal just absolutely goes to zero, a lot of those you've already kind of passed those points along the investment path. And it's like, okay, well, we've done this and that's good. So that's probably not likely going to be an issue going forward. Now well's been drilled. Okay, well, we're not going to run into issues with drilling. So things like that, like I love it because it's, again, there's no guarantees. You just never know. But at the same time, it's very intentional for the deals that we look to bring to investors, to bring these types of deals where there's a lot of the risk has already kind of been taken out, because we're just further along in the process.
Yep. And we're not the largest purchaser in any of them, right? I mean, a lot of times that's another thing we look for, is that the operator has good skin in the game. Going back to that example I gave with the guy where we had the wells go to zero. He didn't have any, he had skin in the game he had his payroll, he had his time put into it, he owned the lease, he'd paid for that years ago, but he didn't have as much money as we had in the game, myself included. And now there was a deal we looked at recently where the operator was only selling a third of their working interest. So they were holding back 2/3 and paying the costs on that, meaning that they've got more money in the game than we do.
And that's always a good signal, right? That they, in how confident the operator, arguably should be the most experienced person in this, in the entire deal, right? At any layer, if they're leaving that much of their own capital in the deal, I think that speaks to how sure they are that it's going to pay off and that their investment's going to be rewarded. You briefly talked earlier about the tax benefits, and I think that's a huge part of this space. You mentioned, an 80% deduction, and you didn't misspeak, right? Like that's a real thing. And I think the example that you gave, you invest $100,000, you get an 80% deduction in year one. If if you're paying at that 50% of taxes, right? Well, that's now $80,000 of income you don't have to pay 50% on. So you just save $40,000. And that's whether the well or the project produces anything, right? Like you're going to get that tax benefit. And to your point, that money's going somewhere. And so you're going to have to pay it. So it's kind of a good thing if you can do some stuff here to avoid sending it to someone that you might not want to send it to. If you don't think the government's the best steward of your money, then here's kind of a way around that. But I think the thing you didn't mention earlier, and Adam, I want you to speak more to this, is that in a traditional value add real estate, you might have some depreciation, right? Bonus depreciation was a big thing when it was 100% a few years ago, and it's slowly been ticking down. Fingers crossed we see a return of that. But the important thing on that was if you had let's say a $10,000 loss, paper loss from depreciation on a real estate deal in year one, that's great. Everybody kind of wants that, but that only offsets your passive income, right? So it might mean that, which is, again, this is good. Any income that was received from that deal that year, you don't owe taxes on because the loss offset it. But if you're a high earning W-2 and you earned $600,000, well, that depreciation loss does not touch, like those sit in two completely separate buckets. And that's not the case in oil and gas.
No, yeah. So for an oil and gas investor, I'm not a CPA, but I feel like I've had one tell me this enough times that I can probably say it. But always consult your own professional. But it's in IDC. It's not depreciation, right? It's intangible drilling costs. It's a part of the tax code. I think it's 23 CRF, something like that. 26, something like that. Look, Google IDC if you want to see it.
You're obviously not a CPA.
I mean, I'm not a CPA. But the tax code, it's been around since 1913 when IDC was implemented. And it just states that if you're a general partner in an oil and gas deal, which all of our partners that we bring in are, unless they don't want the active deduction, then they're able to take their initial intangible drilling cost loss, right? Because there's a loss due to the cost to drill the well. It's a sunk cost into the drilling, and offset other active income with that. And even states like California accept it. I mean, I know that from my own tax return. And so if we have an $80,000 deduction, you're able to take that against your active income. So if you're making $80,000 a year and you just happen to be high net worth, you could offset 100% of your income in year one with $100,000 investment. And then second to that is there is depreciation on top of that, right? So all of the equipment that sits on the well, let's say another 10%, taking us up to 90, is either bonus depreciable or is on a 5-year depreciation schedule normally. So you're able to take the rest of that deduction at least over 5 years, so 2% a year on that. You also get a deduction on the gross production value. So if if there's $100 of oil produced, one barrel sells at $100, and you have that $100, then you pay taxes on it, you pay expenses, whatever that is, you get to take a 15% of gross deduction. So if you produce $100, you get a $15 deduction, even if you only really walked away with, let's say, $50 in your pocket. The rest was eaten up through taxes or operating expenses. And, some states there's 12% severance tax, and then say $40 operating expense. So now you're walking away with $50, but you're only paying tax on 35 of that. Now it is true that all the income that comes to you in the following years, because you were a general partner in the first year, is an active income, so you will have a tax issue down the line. But as these continue to work, you can do more of them or build other tax strategies. And then after the first year, we do transition people to a limited partner so that they have a reduced risk from a general liability standpoint.
And I want to touch on that. I think I just kind of realized us talking about it, we might have buried the lead here, but we've referenced the cash flow from these, and of course, in addition to the tax benefits, that's the other reason for one, we like these investments. They are cash flowing investments, and so it's a fairly high amount of cash flow when compared to, say, a multifamily value add property, right? So that's if you're thinking about sort of where this might sit in a portfolio, it's obviously the tax benefits can almost be. I would almost encourage people to treat those on their own, right? That's a thing, and this is a tool that you can use in your overall tax strategy. But then this is just another cash flowing investment, and so ideally these wells produce for several years, decades, ideally. We talked earlier about treating the first, your investment amount of cash flow as a return of capital. And I don't think we mentioned this, but we target deals where that's returned within that point is hit within 18 to 24 months.
Yeah, I normally like to think about it in 36 months, right? Because if there's a slower production or anything, my baseline is if we can get capital back in 3 years plus a tax benefit, I think it's a good deal, right? Because on the flip side, you've got real estate where you're probably going to be close to 5 to 6 years to really see capital back, and you're going to see slow production, right? So, and if we're really saying this is kind of the inverse of how my personal philosophy is with real estate, then I kind of want to see it on the flip side of that, right? I want to see that production up front. And when we do horizontal fracked wells, we see much more production in the first year, right? So the first year might be 50%, and the next year might be 30%, and then we might be 10%. And so, we might be 3 years to get all the capital back, but a bulk of it should be in the first year or so. Me and you did a deal personally in August, and it seems like it's going to be about an 18% return in the first 6 months. Now it's declining, right? So I don't think the next 6 months are also going to be an 18% return, but we'll see what they're like.
18% in 6 months is 36% annualized, so that's pretty good. Plus we're getting the tax benefit,
Yep,
which is nice.
it's one of the slower producing wells we've been a part of.
Yeah. I wanted to make sure we hit that to again reinforce that these are cash flowing investments, and it's a real asset. This is real tangible oil. So it's different from real estate, but the attributes that we like about real estate, a lot of them also apply in this space as well. I do want to circle back. You mentioned that the investors come in as a GP. And I think this is something that probably a lot of folks, especially if you've never been in this space before, you don't realize. But in the standard syndication, you've got the general partners that generally do all the work and the limited partners that put up the capital. And the beauty of being an LP is that there's generally you have no liability beyond your initial investment, right? So if you invest $100,000, that's basically the most you could lose. No one's going to come after you. You're not signing on a loan for a building. So your kind of maximum exposure is your investment, $100,000, let's say. To get that active, tax benefit, you have to come in the first year of these oil and gas deals as a general partner, which does mean there's some level of additional liability that exists that might not exist in the standard real estate deal. We think it's small, but Adam, I just want to hear you talk about that a little bit more.
Technically, right to the IRS code, it's unlimited general liability, right? So come take my house type of stuff. But I've talked to asset protection attorneys about this, and I think we can find the video too, as we might put it in the show notes. But we've got, I talked to an asset protection attorney, and their opinion was, yes, it's risk, but you also have, there's so much risk we participate in, especially in the US, where there's endless frivolous lawsuits where you create more risk on a daily basis driving your car down a highway, risking to hit someone. She gave me an example of there was a client who there was a motorcycle in California lane splitting, legal, and the client accidentally hit the motorcycle, and then the guy on the motorcycle got awarded $52 million. So I think there was more risk there than on an oil and gas deal where the operator carries insurance, and sometimes we carry insurance, not on our fund level, but kind of the asset manager above us. There's lots of layers, and it's not to say that something couldn't come through, But also, it's only in the first year, which is when most of the risk is. You're drilling, but it's not like, oh my God, something happened on this oil well I invested in 25 years ago, and now I have all this risk. Right? I mean, you're converted to a limited partner. Not every partnership does this. Actually, our CPA was telling me the other day, and he mentioned it on a webinar. He was like, "Yeah, Adam's good because he converts people after the first year. We have people that aren't willing to do that because they don't want to deal with the paperwork." And it's literally just a one-page piece of paper, but after a year, you're a limited partner.
Wow. Well, and I think that's, again, it's something to be aware of. It's something most people aren't aware of, but it's something to realize that there is a risk, but it's also, not all risk is made equal, right? And so yes, there's a non-zero chance of something happening here, but in the real world, you talk to attorneys that have dealt with these situations, you start to realize that, when you leave your house to drive your car to work or, to the grocery store or whatever, you're actually taking on way more risk in just that simple daily activity that you don't think anything about than having some, this exposure, so to speak, as a GP in an oil and gas deal.
Yeah, I told my asset protection attorney a while ago that, I fly planes, I race cars, I own a motorcycle, I own rental property, I go scuba diving. There are other things that I do, right? And they're like, yeah, the oil and gas isn't the riskiest thing.
And I do think it underscores, though. I mean, I assume some point in the future, I'd like for us to do an episode dedicated to asset protection, but that's an important part, right? And I think this kind of plays into why it's important to have a strategy there. And I think the more confident you are in your asset protection strategy, then even the smaller amount that this risk actually becomes, and you can kind of go into any of these deals confident that it's not going to be something that's ever going to present some sort of massive problem for you.
Well, there's an interesting white paper the asset protection company wrote. Is it possible for them to send an email to something and get a copy of that?
Yeah, we can absolutely do that. If folks want to send an email to assetprotection@wealthindependencepod.com, and we'll make sure that's linked in the show notes as well. But send an email to assetprotection@wealthindependencepod.com. We'll make sure to get you a copy of the white paper that our preferred asset protection attorneys put together and literally wrote the book on this topic, right? So also happy to, again, this further underscores we're not attorneys. This is not our area of expertise, but we've got folks that we've talked to, we've worked with a lot, and we're happy to make a referral, and certainly happy to send more business their way. We've been, both Adam and I have been very happy with the services they've provided.
Yep. So
this is a topic we could spend hours on. There's a lot more depth on, I think, probably all the high level points that we've hit, but hopefully this can kind of act as a good overview. If you're new to the space, and we try to do several of these types of deals each year. Obviously the ones towards the end of the year tend to be a little bit more popular once folks start realize what their tax bill is going to be, but that doesn't mean that for a deal earlier in the year that it's not worth investing in. You kind of go ahead and lock in that tax benefit for the rest of the year. But I don't know, Adam, any other points to add on this?
I think we covered it. I mean, as always, reach out to us if you got questions, if you want to learn more. It's a large pool of information on oil and gas, and there's always something new to learn. We're by far not the experts in it, right? But I've been doing it for about 5 years, and I feel like I have a good grasp on it, at least enough to seemingly continue to put my own money into it. And I think we've found some deals that we're happy continuing down the path for. We've got a good lead source, and seems to be that things are working with it.
Well, that's awesome. We'll go ahead and get on out of here for this episode. We appreciate everybody listening. And just remember, where freedom leads, real wealth follows. Thanks, everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.